41,000. That is the number they wanted you to see. That is the number every mainstream financial network plastered across their lower thirds this morning. Private sector jobs up by 41,000. A sign of resilience. A sign that the soft landing is here. A sign that you can go back to sleep, keep buying the index funds, and trust the Federal Reserve. But while you were digesting that headline, while you were being told that the labor market is stabilizing, the smartest money in the world, the sovereign wealth funds, the central banks, and the institutional giants, saw something completely different. They didn't look at the headline number, they looked at the breakdown. And what they saw terrified them enough to trigger one of the most aggressive moves into physical silver we have seen in decades. Because that 41,000 figure is not a sign of growth. It is a mathematical deception masking a catastrophic collapse. The headline says, we added 41,000 jobs. But when you open the ledger, when you look at the specific sectors, you see the truth. The economy just lost 29,000 professional and business service jobs. It lost 12,000 information and technology jobs. That is 41,000 high-paying, high-productivity, tax-generating careers vanished in a single month. Gone. They were replaced by low-wage, part-time roles in government-subsidized healthcare and hospitality. We are trading software engineers for orderlies. We are trading architects for bartenders. This isn't a recovery. It is a rotation from a productive economy to a servant economy. And history tells us exactly what happens when an empire destroys its productive middle class while drowning in debt. It is the final signal before the controlled demolition. By the end of this video, you will understand why that 41,000 number is the specific trigger for what comes next. You will understand why silver is disappearing from physical vaults in London and Shanghai at a rate that is mathematically impossible to sustain. And you will understand that what is happening right now is not a recession, it is a robbery. This is not a prediction. This is a pattern. A 4-stage cycle that has played out 3 times in the last 500 years with 100% accuracy. We are watching the exact same sequence, the exact same data points, and the exact same denial that destroyed the Spanish Empire, the Dutch Republic, and the British Empire. And unfortunately, we are not at stage 1. We are at the very end of stage 3. Let me explain the pattern, because once you see it, you cannot unsee it. Every dominant economic power follows the same 4 steps into oblivion. Stage 1 is the ascension. The empire builds real wealth through production, trade, and hard money. It becomes the world's creditor. Everyone needs its currency. Stage 2 is the overextension. The empire becomes arrogant, it stops producing and starts financing. It fights too many wars, builds too much bureaucracy, and covers the cost by debasing its currency. But it feels good. Stocks go up, real estate goes up, the rot is hidden by debt. Stage 3 is the silent exodus. This is where we are today. This is the stage where the productive economy quietly collapses from the inside, while the elite, the insiders, the politicians, the central bankers, quietly move their wealth out of the system. They sell the currency, they buy hard assets. They position themselves for the end, all while telling the public that everything is fine. Stage 4 is the controlled demolition. The debt becomes mathematically unpayable. The currency is sacrificed to save the bond market, or the bond market is sacrificed to save the currency. Either way, the middle class is wiped out. The wealth doesn't vanish, it transfers. It transfers from those holding paper to those holding things. You might think this sounds like doom-mongering. You might think America is special, but history does not care about American exceptionalism. It cares about math. And the math has broken 3 times before in exactly this way. Look at the Spanish Empire in the late 1500s. Spain was the master of the world. They had the global reserve currency, the real. They had an endless supply of gold and silver flowing in from the Americas. They felt invincible, but they stopped producing. Why build factories when you can just plunder gold? They outsourced their manufacturing to the Netherlands and Italy. Their domestic economy became hollow. By the 1590s, the Spanish middle class was gone, replaced by a servant class catering to the aristocracy. When the debt crisis finally hit in 1596, the king didn't cut spending. He devalued the currency. The cost of living exploded. The empire collapsed, not because of an invading army, but because they had destroyed their own productive base. Stage 2 verified. Now, look at the Dutch Republic in the 1700s. Amsterdam was the financial center of the world. They invented the stock market. They invented central banking. They were the smartest guys in the room. But by 1750, they stopped building ships and started trading paper. They financialized their economy. The wealthy got richer, speculating on stocks, while the working class saw their wages stagnate for 40 years. Sound familiar? When the crisis hit in 1795, the guilder didn't just dip, it evaporated. The Dutch Golden Age ended overnight because an economy built on financial speculation cannot survive a contact with reality. Stage 2 verified. And then there is the British Empire in the early 1900s. The pound sterling was as good as gold. London controlled global trade. But they spent too much. They fought too many wars. They built a welfare state they couldn't afford. By 1931, the debt was so high, they had to abandon the gold standard. They defaulted on their obligations to the world. The pound lost its reserve status, and the standard of living in Britain collapsed for a generation. 3 empires, 3 centuries, same pattern. They hollowed out their productive economy. They covered it up with debt. They lied to their citizens about the stability of the system. And in every single case, the collapse happened right after the safe haven rush began. And that brings us back to the 41,000 jobs report. This number is the modern equivalent of the Spanish king telling his court that the gold shipments are still coming. It is a lie designed to buy time, because beneath the surface of that report, the American economy is screaming. When you lose 41,000 high productivity jobs in a month, you are not just losing paychecks. You are losing the engine of your economy. These are the people who buy houses. These are the people who buy cars. These are the people who pay the taxes that fund the interest on the national debt. When you replace them with part-time government-subsidized workers, you are increasing the burden on the state while decreasing the revenue to pay for it. It is a death spiral, and the insiders know it. That is why they are panicking. That is why, while the news anchors were smiling about job growth, the silver market was experiencing a massive, coordinated withdrawal of physical inventory. You see, silver is the Achilles heel of the manipulated financial system. It is the one asset they cannot print. They can print dollars. They can print jobs reports. They can print liquidity to prop up the stock market. But they cannot print silver. And right now, the industrial demand for silver, for solar panels, for electronics, for batteries, is exploding at the exact moment the smart money is rushing to buy it as a shield against the coming currency collapse. We are seeing a convergence of forces that we haven't seen since the 1970s. But this time, the debt levels are 100 times higher. This time, the manufacturing base is gone. This time, there's no Paul Volcker coming to save the dollar. The 41,000 number was the signal. It was the confirmation that the productive economy is dead. The soft landing is a myth. The resilient consumer is a lie funded by credit cards. The system is running on fumes, and the people who actually understand the mechanics of money are heading for the exits. They are moving into assets that have no counterparty risk, assets that don't depend on the solvency of the U.S. Treasury, assets that don't depend on the honesty of the Bureau of Labor Statistics. They are moving into silver. And if you're not positioning yourself alongside them, you're positioning yourself to be the victim of the greatest wealth transfer in human history. But to understand why silver is the specific target and why this specific jobs report was the trigger, we have to go deeper. We have to look at what the banks are doing behind the scenes. We have to look at the COMEX vaults. We have to look at the physical premiums in Shanghai, because the data is there, it is public, it is verifiable, and it is screaming that the time is running out. This is not about getting rich quick. This is about survival. This is about making sure that when the music stops, and it is about to stop, you're holding a chair, not a bag of worthless paper. Let's dig into the mechanics of the collapse. Let's look at stage 3, the silent exodus. Because while you're watching the S&P 500 hit new highs, the foundation is rotting away. The silent exodus is the phase where the smart money quietly leaves the theater before someone yells, "Fire." It happens in every collapse. In Spain, the Genoese bankers started demanding payment in physical gold instead of Spanish bonds 3 years before the default. In the 1920s, the French central bank started converting their British pounds into gold massive quantities 2 years before the pound collapsed. They didn't hold a press conference. They didn't announce it on the radio. They just did it, quietly, systematically. And today, look at who is selling U.S. treasuries. China is selling. Japan is selling. Saudi Arabia is selling. The Federal Reserve itself is selling. Who is buying? You are. Your pension fund is. Your insurance company is. The public is being loaded up with the debt that the insiders are dumping. And where is that money going? It is going into hard assets. It is going into farmland. It is going into energy infrastructure. And most aggressively, it is going into precious metals. But why silver? Why not just gold? Because silver is the most undervalued asset on the planet relative to the money supply. In 1980, gold was $850 and silver was $50. Today, gold is over $2,600 and silver is sitting at $30. That ratio is a mathematical anomaly. It creates a coiled spring. And when you combine that undervalued price with a sudden panicked rush for safety, triggered by the realization that the U.S. labor market is imploding, you get an explosion. You get a short squeeze that will make GameStop look like a lemonade stand. The 41,000 jobs report was the match. The silver market is the powder keg, and the U.S. debt bubble is the building sitting on top of it. Most people will ignore this. They will look at the stock market and say, "I'm making money, why worry?" They are like the passengers on the Titanic dancing in the ballroom after the iceberg hit. The ship is already sinking. The water is already in the lower compartments. The fact that the music is still playing doesn't change the outcome. The water in the lower compartments is the jobs market. It is the manufacturing sector. It is the commercial real estate market. It is drowning. And the 41,000 number was the captain telling you that the slight tilt in the floor is just normal operational variance. Do not believe the captain. Believe the water. In the next section, we are going to look at the specific data from the silver market that proves the panic has already begun. We are going to look at the inventory levels on the COMEX, which are at dangerously low levels. We are going to look at the Shanghai Gold Exchange, where silver is trading at a 10% premium over the West, a massive arbitrage signal that physical metal is draining from west to east. This is the silent exodus in real time. The wealth of the West is being drained, ounce by ounce, bar by bar, while the public is distracted by fake jobs reports and political theater. You have a window of opportunity here. A small window where the price is still suppressed, where the paper game is still working, where you can trade your depreciating currency for real money at a discount. But that window is closing. The 41,000 jobs report was the bell. The rush has begun. And in a moment, I'm going to show you exactly how fast the physical supplies are vanishing. Let's look at the numbers they do not show you on the morning news. Let's look at the COMEX in New York and the London Bullion Market Association. These are the two pillars of Western price discovery for precious metals. For decades, they have controlled the price of silver by trading paper contracts, promises to pay silver that doesn't actually exist. It is a fractional reserve system, just like your bank account. They sell 100 ounces of paper silver for every 1 ounce of physical metal sitting in the vault. It works perfectly, as long as nobody asks for the real thing. It works perfectly, as long as confidence in the dollar remains high. But the moment confidence breaks, the moment a report like the 41,000 jobs number reveals the rot inside the system, the big players stop trusting the paper. They stand for delivery. They want the metal in their hand. And that is exactly what is happening right now. Since the start of this year, the registered category of silver at the COMEX, that is the metal actually available for delivery, has plummeted to levels we haven't seen in nearly a decade. We are watching a bank run on physical silver. But it's happening in slow motion behind the scenes where the retail public can't see it. But the Chinese can see it. The Indians can see it. And this brings us to the most dangerous part of stage 3, the geographic arbitrage. Right now, as I speak, silver is trading at a significantly higher price in Shanghai than it is in New York or London. This is called the Shanghai Premium. In a normal market, arbitrage bots would close this gap instantly. They would buy in New York and sell in Shanghai until the price is matched. But the gap isn't closing, it's widening. Why? Because the metal is leaving the West. It is being drained from London vaults, put on planes and ships, and sent east. The West is selling its family silver to keep the paper game going for just a few more months, while the East is accumulating real assets for the next century. This is the exact same mechanism that destroyed the Dutch Republic. I want you to really understand this example, because it is the blueprint for 2026. In the mid-1700s, Amsterdam was the New York City of the world. It was the center of finance. But the Dutch productive economy was dying. They had high taxes, high wages, and a massive debt burden from endless wars. They couldn't compete with the rising industrial power of Britain. So what did the Dutch elite do? Did they reinvest in their own country? Did they try to fix the manufacturing base? No, they chased yield. They started investing their capital in British debt and British stocks. They sent their gold and silver to London because the returns were better. They hollowed out their own financial system to fund their replacement. By the time the crisis hit in the 1780s, the vaults in Amsterdam were empty. The capital had fled. The Dutch guilder collapsed because there was nothing backing it anymore, just empty promises and debts owed by a rival power. The Dutch elite survived because they held British assets. The Dutch middle class was wiped out because they held guilders. Fast forward to today. Look at the flow of gold and silver. It is moving from west to east, from the US and UK to China and India. Last month alone, India imported more silver than they usually import in an entire year. Why? Because they are building the solar panels, the electronics, and the infrastructure of the future. They need the physical metal. They don't want paper promises from a bankrupt American government. They are doing exactly what the British did to the Dutch. They are draining our productive assets while we play games with paper derivatives. And the trigger for this acceleration? It's the realization that the U.S. consumer is tapped out. That is what the jobs report told them. When you lose 29,000 professional jobs, you lose the discretionary spending that drives the U.S. economy. You lose the ability to service debt. The global smart money knows that the U.S. government has only two choices left. Option A, allow the deflationary collapse. Let the bad debt clear. Let the stock market crash 80%. Let the zombie companies fail. This would save the dollar, but it would destroy the political class and the banking system. They will never choose option A. That leaves option B, inflate the debt away, print money to pay the bills, yield curve control, universal basic income, stimulus checks disguised as relief. They will print until the zeros on the currency lose all meaning. This is why silver is the safe haven rush. Because silver is a monetary metal, yes, it has been money for 4,000 years, but it is also an industrial metal. It is essential. You cannot print a solar panel. You cannot print a cruise missile guidance system. You need physical silver. So you have a dual driver for the price. Monetary panic driving investors to safety, and industrial desperation driving corporations to secure supply. It is the perfect storm, and history shows us that when this storm hits, it hits fast. In 1970, the price of gold was $35. By 1980, it was $850. That is a 24x return in a decade. But silver? Silver did even better. It went from under $2 to $50, a 25x move. But here's the difference. In 1980, the U.S. debt was roughly 30% of GDP. Paul Volcker could raise interest rates to 20% to stop the inflation. He could save the dollar because the debt was manageable. Today, the debt to GDP is over 120%. If the Federal Reserve raised rates to even 10%, the interest payments on the national debt would consume 100% of all tax revenue. The U.S. government would be instantly insolvent. There is no Paul Volcker coming. There's no brake pedal. The only way out is through the destruction of the currency, through the repricing of gold and silver to levels that seem impossible today. The panic we are seeing now, the 41,000 jobs collapse, is the start of the psychological shift. Stage 3 is ending. Stage 4, the controlled demolition, is appearing on the horizon. In Stage 4, the rules change completely. In Stage 3, you can still buy silver at a reasonable premium. You can still order coins online and have them shipped to your door. You can still walk into a coin shop and find inventory. But when Stage 4 triggers, the physical market disconnects from the paper price. The spot price on your screen might say $35, but try to buy an ounce for $35. You won't find it. The dealers will be sold out. The premiums will be 100%. The paper price becomes irrelevant because nobody is selling real metal for paper money anymore. We saw a preview of this in March 2020. The paper price crashed, but you couldn't buy a silver eagle for less than a 50% premium. That was a glitch. What is coming is not a glitch. It is a permanent revaluation. The 41,000 jobs number is the signal that the deflationary bust has begun in the real economy. The Fed will panic. They will panic because they cannot allow a depression in an election cycle or in a time of geopolitical war. They will pivot, they will cut rates, they will print, and the market knows it. That is why silver is moving before the Fed cuts. The market is front-running the inevitable liquidity injection. You need to understand the psychology of the safe haven. It is not about making a profit. It is about not losing everything. When the Dutch guilder collapsed, the people who held gold and silver didn't make money in real terms. They just preserved their purchasing power while everyone else lost theirs. They were the only ones left with capital to buy up the wreckage when the dust settled. That is the opportunity here. Not to get rich in fiat terms, but to be one of the few standing with real capital when the dollar system resets. In the next part, I'm going to walk you through the rule of 3 in even more detail. I want to show you the specific timeline of the British collapse in the 1970s and how it mirrors the US timeline almost month for month. We are going to overlay the charts. We are going to look at the winter of discontent and compare it to the current labor strikes and social unrest. Because the pattern is fractal, it repeats on the macro scale and the micro scale. And right now, every single indicator is blinking red. The 41,000 jobs report was the first domino. The silver panic is the second. The third domino is the bond market. And when that falls, the game is over. Stay focused. Do not let the daily noise distract you from the secular trend. The era of the dollar is ending. The era of hard assets is returning. And you have a very short time left to position yourself on the right side of history. Let's deepen the investigation. Let's look at the British Empire's final days as the financial superpower and see exactly what it tells us about your bank account in 2026. Let's look at the ghost of empires past. Let's look at Great Britain in 1976. Most people remember the disco and the bell-bottoms, but financial historians remember it as the year the sun finally set on the British Empire. And when you overlay the charts of London in 1976 with Washington, D.C. in 2026, the correlation is not just similar, it is terrifying. In the mid-1970s, Britain was known as the sick man of Europe. Their debt was spiraling. Their manufacturing base had been decimated by cheaper labor abroad. Their politicians were printing money to pay for social programs they could no longer afford. Sound familiar? But the real signal, the one that matches our 41,000 jobs collapse perfectly, was the labor market. On paper, unemployment wasn't catastrophic yet. but the quality of the jobs had collapsed. The productive industries, coal, steel, shipping, were dying. They were being propped up by government subsidies and nationalization. The government was hiring people to dig holes and fill them up again just to keep the headline numbers looking acceptable. Then came the winter of discontent. The inflation unleashed by the money printing caught up with the wages. The unions revolted. Garbage piled up in Leicester Square. The dead went unburied in Liverpool because the gravediggers were on strike. The social contract broke. And what did the British government do? They went to the International Monetary Fund. The country that once ruled the waves, the country whose currency was the global standard for 2 centuries, had to go hat in hand to the IMF for a bailout. It was the ultimate humiliation. It was the end of the pound sterling as a reserve asset. Now look at America today. We have the winter of discontent brewing right now. We have dock workers threatening to shut down the ports. We have auto workers demanding 40% raises just to keep up with inflation. We have nurses, teachers, and service workers at the breaking point. The 41,000 jobs number is just the statistical proof that the private sector can no longer support the standard of living the American people expect. The private sector is shrinking. The government sector is exploding. We are printing money to hire bureaucrats to regulate industries that are leaving the country. It is the exact recipe Britain used to destroy itself. But here is the critical part for you. Here is the part about silver. During that collapse in the 1970s, as the pound sterling was losing its value daily, what happened to precious metals in the UK? They exploded. The British middle class who held cash got wiped out. Their savings evaporated into inflation. But the ones who held gold and silver didn't just survive, they thrived. They preserved their purchasing power. And today, the setup is even more explosive. Because back then, the UK was just one country failing. Today, it is the issuer of the global reserve currency. When the dollar sneezes, the world catches a cold. When the dollar collapses, the world goes into cardiac arrest. The silver panic we are seeing now is the smart money anticipating the American IMF moment. They know the U.S. debt wall is hitting in 2026. $35 trillion in debt. $1 trillion in interest payments annually. That is more than the entire defense budget. We are borrowing money just to pay the interest on the money we already borrowed. It is a Ponzi scheme. And like all Ponzi schemes, it works until the new money stops flowing. The 41,000 jobs report says the new money, the productive tax revenue, has stopped flowing. The Ponzi is mathematically finished. Stage 3 verified. The silent exodus is accelerating into a stampede. Now, let's bring this to the immediate present. Let's look at the modern convergence. Because it is not just history repeating, it is history accelerating. We need to look at the insider signals. I told you the smart money is leaving. Let's name names. Let's look at the scoreboard of the elite. Warren Buffett, the greatest investor of all time, the Oracle of Omaha. He loves America. He loves stocks. He loves Coca-Cola. But what is he doing right now? He is sitting on the largest pile of cash in the history of Berkshire Hathaway. Over $325 billion he is selling Apple. He is selling Bank of America. He is not buying the dip. Why? Because he knows the valuation of the stock market is a lie fueled by printed money. He knows that when the 41,000 jobs reality hits earnings, the S&P 500 is going to reprice violently. He is positioning himself to be the buyer of last resort when the blood is in the streets. He is out of the market. Jeff Bezos, selling billions in Amazon stock. Mark Zuckerberg, selling Meta. The Walton family, selling Walmart. The insiders are cashing out at the top of the bubble. They are trading their overvalued paper equity for liquidity. And where does that liquidity go? It goes into land. It goes into bunkers. And yes, it goes into hard assets that cannot be debased. They are preparing for stage 4, the controlled demolition. And then there's the data point that should keep you awake at night, the silver deficit. For the last 3 years, the world has consumed more silver than it has produced. In 2022, the deficit was 238 million ounces. In 2023, it was another massive deficit. In 2024, the gap widened. We are draining the above-ground stockpiles. The vaults in London and New York are bleeding inventory to feed the solar factories in China and the electronics factories in India. We are running out of silver at the current price. It is economics 101. When supply is falling and demand is rising, price must rise. But the price has been held down by the paper market on the COMEX. This is the beach ball underwater effect. They are holding it down with leverage, but the pressure is building. The 41,000 jobs report is the moment the hand slips off the ball. The industrial demand is inelastic. Apple needs silver for iPhones. Tesla needs silver for EVs. They cannot substitute it. They will pay whatever price is necessary. If silver goes to $100, they will pay it. If it goes to $500, they will pay it. Because the amount of silver in an iPhone is tiny, but it is essential. Without it, the phone doesn't work. But for you, for the investor, that repricing is the difference between retiring in dignity and retiring in poverty. The silver panic is not a speculation bubble. It is a supply crunch meeting a currency crisis. It is the perfect storm. And the government knows it. Why do you think they are pushing central bank digital currencies, CBDCs, so hard? Why do you think they want to track every transaction? Because when the dollar fails, they need a way to trap your capital. They need a system where you cannot exit. Physical silver is the exit ramp. It is the off-grid money. It is the asset that has no digital footprint, no counterparty risk, and no kill switch. The safe haven rush is the public waking up to the fact that the exits are being bricked up. The 41,000 jobs report was the sound of the first brick being laid. In the next part, I'm going to show you exactly what Stage 4 looks like. I'm going to describe the scenario of the controlled demolition so vividly that you will feel it. We will talk about the supply chain death. We will talk about the day the EBT cards stop working. We will talk about the hyperinflationary spike that wipes out debt and savings simultaneously. Because this is not just about money, it is about order. It is about civilization. When the economy collapses, society changes. The people who hold the assets that society needs, food, energy, precious metals, become the new architects. The math is absolute. The timeline is set. The 41,000 jobs collapse was the trigger. Now we watch the dominoes fall. Stage 4 is the controlled demolition. This is the moment the theory ends and the reality begins. This is the moment the soft landing narrative is violently exposed for what it always was, a sedative administered to a dying patient. When Stage 4 triggers, it doesn't happen on a schedule that is convenient for you. It happens overnight. It happens on a Sunday evening when the Asian markets open. It happens when you are asleep. And by the time you wake up, the world has changed. Let me paint the picture of what this looks like, not with fear, but with precision. Based on the collapse of the British pound in 1976, the Russian ruble in 1998, and the Argentine peso in 2001, we know exactly how the mechanics of Stage 4 unfold. It starts in the bond market. The 41,000 jobs report was the signal that tax receipts are collapsing. The bond vigilantes, the global lenders who finance America's debt, look at the balance sheet and realize the U.S. Treasury cannot pay its bills without printing the money. They panic. They stop buying U.S. debt. Suddenly, the interest rate on the 10-year Treasury spikes. 5%, 6%, 7%. It moves violently. This sends a shockwave through the entire financial system. The banks holding these bonds suddenly see their capital reserves evaporate. We saw a preview of this with Silicon Valley Bank. But in Stage 4, it isn't one regional bank. It is every bank. The entire banking system becomes technically insolvent in a matter of hours. This is the margin call from hell. The Federal Reserve is then forced to make the ultimate choice, the choice they have been delaying for 20 years. Choice 1, let the system crash. Let the banks fail. Let the stock market drop 80% to find its fair value. This saves the dollar, but destroys the economy. Choice 2, print trillions, print enough to buy every bond, bail out every bank, and fund every government check. This saves the system, but destroys the dollar. They will choose option 2. They always choose option 2. Politics dictates it, survival dictates it, and that is when the crack-up boom begins. This is the phase of Stage 4 that confuses the average person. The stock market will skyrocket. This is the money illusion. You feel richer because you have more dollars, but you're poor because those dollars buy nothing. Your pension fund hits a record nominal value, but it can't buy a used car. The middle class is wiped out not by a crash, but by the relentless, suffocating math of negative real rates. But the most terrifying part of Stage 4 isn't the inflation. It is the supply chain death. Our modern economy is built on just-in-time inventory. Grocery stores have 3 days of food. Gas stations have 2 days of fuel. Factories have 1 week of parts. This entire delicate web is held together by one thing: trust in the currency. When suppliers lose trust in the dollar, they stop shipping. Why send a cargo ship of electronics to Los Angeles if the dollars you receive will be worth 10% less by the time the ship arrives? You don't. You cancel the shipment. You demand payment in gold. You demand payment in yuan, or you just keep the goods. We saw this in 2021 with the supply chain snarls. That was a rehearsal. In Stage 4, the letter of credit system, the plumbing of global trade, freezes. Ships stop moving. Shelves go empty. Not because there is no food, but because there is no trusted medium of exchange to move it. This is when the panic shifts from financial to physical, and this is where silver becomes unobtainium. In Stage 4, the paper price of silver on the COMEX becomes irrelevant. The COMEX will likely declare force majeure. They will say, due to extreme market conditions, we are settling all contracts in cash. They will write you a check for the paper price, but you cannot eat a check. You cannot build a solar panel with a check. You cannot protect your wealth with a check that is losing 15% of its value every month. The physical market will completely disconnect. The premiums will explode to 100%, 200%, 500%. You will see people offering $100 for an ounce of silver and finding no sellers. Because in a currency collapse, nobody wants to trade a hard asset for dying paper. The spot price you see on TV will be a ghost, a number that exists only in the fantasy land of derivatives. The real price will be what you can negotiate in the street, and that price will be measured in survival, not dollars. This is the controlled demolition. It is controlled because the elites are guiding the collapse to wipe out your debts and your savings simultaneously, allowing them to reset the system on their terms. It is a demolition because the old way of life, the cheap credit, the cheap goods, the American dream, is being brought down to make way for the new digital feudalism. The 41,000 jobs report was the charge being set on the support beams. The silver panic is the sound of the foundation cracking. You're watching the greatest wealth transfer in history. Wealth is never destroyed. It is merely transferred. In stage 4, it transfers from the oblivious to the prepared, from the creditors to the debtors, from the paper holders to the asset holders. If you are holding U.S. treasuries, you are the victim. If you are holding cash in a savings account, you are the fuel for the fire. If you are holding physical silver, gold, land, and productive assets, you are the lifeboat. The math is absolute. There is no political solution. There is no voting your way out of a debt spiral. There is only positioning. And right now, the window to position is closing. The silver panic is the closing of the door. The smart money is squeezing through the gap before it slams shut. When stage 4 hits full velocity, the psychological shock will paralyze the masses. They will wait for the government to save them. They will wait for the stimulus check. They will wait for the war on inflation to work. They will wait until it is too late. Do not be the masses. Be the historian. Be the one who recognizes the pattern. We are staring at the event horizon. The 41,000 jobs number was the final warning. The safe haven rush has begun. The system is tilting. In the next part, I'm going to tell you exactly what you need to do. I'm going to break down the survival portfolio. I'm going to explain why you need to hold your assets outside the banking system. I am going to give you the specific ratio of gold to silver you should target for this specific crisis. Because knowing the building is going to collapse is only half the battle. Knowing where the exit is and having the key to open it is the part that saves your life. This is not a drill, this is the end game. And you are the main character in the story of your own survival.